Okay, good morning, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Wednesday, December 13th, and it is FOMC day. We just got the release of US CPI, guys, coming in slightly softer than expected on the month-on-month read, specifically the core. You're seeing the dollar take a little bit of a hit here, a welcomed move. But really, all eyes will move to the FOMC interest rate decision later today. We'll go over the implications, what to look for in the release. On the menu for today, obviously the DXY is highlighted. Euro, pound, Aussie, Kiwi, dollar, yen, all the dollar majors, and dollar CAD is what I have on the list for today. Could take a look also at pound Oz from earlier in the week. We've been following that one, still moving lower. Also, and gold, which is coming still and just sitting there at a massive, massive support level. So be mindful of any short exposure on that side. All right, as usual, questions, trade setups you want to review anytime. Feel free to throw them on the message board, guys. So we're heading into the FOMC interest rate decision. I gave you kind of a little synopsis yesterday. The quarterly projections are really going to be what the focus is on. The 25 basis point hike is already priced in. I can't stress that enough. You're still going to get those retail traders who are trying to go long because they raised rates. That's not the trade, right? The dollar could still rally, but it'll be really based on what we see here in the underlying metrics. So if you recall from the release in September, the only move that we saw was PCE inflation, the personal core or the personal consumption expenditure rather. From the June print, you saw them reduce that expectation to 1.9. That was the only change that we saw, both on the core PCE and PCE. So softening the inflation expectation, what does that mean? It means a slower path of hikes, interest rate hikes moving forward. That's what the market is interpreting, and that's why you have to be looking at this data with that mindset. So if they're looking to see, oh, inflation is probably going to take even longer than expected, remember the Fed has a dual mandate, price stability, i.e. inflation, and fostering maximum employment. Well, we're pretty much at the quote-unquote natural rate of employment right now. So the focus has always, or has been, on the inflationary outlook. So this is going to be where we're going to get the juice today. Keep your eyes on this. Again, we'll get the updated metrics. Here's the link, by the way, for the Fed's monetary policy page, guys. I'm going to throw it. Actually, I need someone to send a message. Someone just send me anything so I can respond to everyone with this link. Thanks. Thanks, Pooja. So guys, in the message box, I just sent it to all. That's the link for the monetary policy page. As soon as it updates, you'll see it show up right here under projection materials. It'll be the new PDF for December. Okay, so keep your eyes on that inflationary outlook. Also, the interest rate dot plot, this is what everyone seems to take their cues from. It's the big market mover. As it stands right now, the majority or the median estimates for the Fed committee is between 2 and 2.25 is where we'll end up in 2018. It gives us an expectation of how many interest rate hikes we should be expecting. So if this were to increase, you see a growing number pile up here, shouldn't make that big of a difference. The question becomes, do you see more of these bottom guys move higher from 1% to 1.5? Remember, we have a mix-up in the committee, okay, members next year. This is Janet Yellen's final policy meeting as chairman. So while there's no major expectation shifted to as far as what the policy outlook will be, this is kind of be her last hurrah, and whether she leaves us on a note with a little bit more of a hawkish stance, the dollar could take off from here. Our base case scenario, guys, is that even if the dollar does turn around and rip, we hold in this region between 94.41 and 94.23 on the index. That's really the big focus for me. So we know what to look for. Oh, the other thing, one last thing, the longer run, this is the natural rate of interest rates, or the longer running rate, you'll hear it heard. So again, here you see the majority of members see us steady at 3%. So long term, sitting out there a little bit further out, you're looking at pretty much a 3% static rate. Okay, if it continues to bump higher, remember historically rates have been much higher than 3%, guys. This is kind of an undershoot. that would be supportive for the dollar. I'm giving you the scenarios of which I don't want to see, to be honest with you. So you know where to look. The updates will be out promptly at 2 o'clock. The Fed page gets overwhelmed, so keep hitting refresh. I will provide you with that tweet as soon as possible with the comparison, side-by-side comparison. But these are the factors that we'll be looking at heading into the interest rate release later today. So where does that leave us with price action? Well, we've been following the dollar sort of breakout, as it were, while it broke above 93.50 for the last couple of days. 94.20, I know it's really 94.14. It's 94.14 to 94.41, excuse me, is a big range of resistance. You're looking at former swing lows, former swing highs, the 1618 extension from the advance off the low, the 618 retracement from the decline off the high. All of them line up right here. So kind of a natural area of which you'd start to look for some resistance. So that's the daily chart. Okay, intraday, and this is what we'll be following. You know, this is basically a big level right here. Pooja saying your Aussie dollar at target 75.99. Yep, I'm still in it. Might be a good area to take some off. Actually, guys, give me one sec. Yeah, there's the 89 level. And 618's at 75.95 too. We'll see. I'm willing to let this one ride a little bit. I think we got such a perfect entry. I'm just reluctant to peel any off until we get some reason to think so. So Pooja, thanks for bringing that up. But I will revisit that in a moment. So yesterday we highlighted this level, and you know the major region of resistance that we're looking at. It extends into 94.27 just on account of these former swing lows here, but really it's the 94.23 into 94.14 region. Okay, that 618 extension, 618 retracement, nice pivot in price, former swing highs, former swing lows, former swing highs, all in this region. The median line was there too. So on that fact, you also had some building divergence, right? Price action making a higher high, the oscillator making a slightly lower high. So I don't want to get too excited. This is support, 93.81, okay? We're there right now. This is a basic 236 retracement of the advance off the lows, nothing fancy. But it's also the near-term lower median line parallel. Okay, so I wouldn't be too surprised to see this thing get hung up a little bit here, which is why I think Aussie could get capped near term. Obviously, the data print that we got, that weaker CPI print, has also continued to propagate this a little bit lower. But the emphasis is on this region near term. Okay, 93.81. I would just be watching 93.67, the opening range low, objective opening range low for the week. I would just be watching that. Wouldn't necessarily peel out of any positions, but I'd want to see us kind of sail through that with no problem. That would give us an objective weekly opening range break. Right on, right? But first things first, you are checking near-term support right here at 93.81. Interesting stuff. Beautiful levels ahead of the release. Okay, this could go both ways. Obviously, who knows what the hell Ellen's going to say, but you know, all things held constant, guys. If this thing is to spike back into resistance, I'd still be looking for some sort of exhaustion here. If we rip through, okay, you know, you see a whole big pileup of dot plots start to mount at 2.25 for next year instead of between 2.25 and 2. Then look for the November open, 94.63. Okay, if, and I'm just playing scenarios here. This is just kind of complete conjecture. But if it were to move higher here, tag this region, then close the day back below 94.20, 94.23. Still, in my mind, that would be pretty bearish. Okay, we have to keep into account where the dollar is trading on whole. Okay, and there's that 95.15 level. That's last month's high. So, you know, just to take a look at this on the weekly. And obviously, we talked about the low week reversal close from 2015. That's exactly what we're straddling right now. Nothing matters here until obviously the weekly close, so a lot can happen between now and then. We still got the ECB and BOE on tap. You know, the 95 level is there still, and it would still keep us below, you know, the median line. So we've been pivoting resistance, hold up here for a little bit, break, fueled the rally, saw really strong defensive support. The break again saw acceleration, instant resistance. It's not outside the realm of possibility we test it yet again. Not my favorite scenario, but I have to keep you guys prepped for what could happen, right? Trading is a whole game of if-then. So we have to kind of keep the levels objective. Don't get caught up in the moment. Our ideal scenario is that the dollar starts to fail. If it plows through 94, 95.15 is right on tap. Don't fight it. Don't fight it. Okay? Questions on the index, what to expect from the FOMC, or anything with regards to today's event risk? Typically, these interest rate decisions, again, when they're just the old run-of-the-mill decision, not too big necessarily, but because this is Yellen's last sort of, hurrah as chair, because we have the market so heavily priced, it's 98% chance we'll get a 25 basis point hike today. So that's what the markets have priced in fully, essentially. The devil's all in the details. Her commentary, her accompanying remarks, and specifically the updated projections in the dot plot will be everything today. All right. Moving right along, let's jump into the fun stuff. So that's DXY, number one. We're all ready for that. Number two is euro dollar. Here's what the euro looks like. Again, me and Jamie were looking for the same thing. We're kind of looking for settling here. I thought 1709 would still be a prudent level to keep an eye on. Let me show you the bigger picture here. So here's, I guess, start from the week up. Here's the weekly chart of euro dollar. Okay, 117.14 is the simple 2015 highs. Now, obviously, we made two breaks of that level over the last couple of months, but on a closed basis, it's still pretty, it's still something I'm watching, right? The pivot on both sides has been pretty radical. So if we were to break below, you'd expect to see that straight shot right into 1616. That's the 2016 highs. But as it stands right now, yeah, all right, fine. Could be a little bit of a support level, right? Looking at this from the daily chart, well, we're kind of at the median line. Again, we're probing below, but on a closed basis, we've basically been sitting right there. So what do? Well, you can't just go long, right? It was a pretty hard break. You look for more near-term structure to help us guide us or give us a little bit more of a conviction that, you know what, there might be a good level to turn from here. Well, that's where we jump into the intraday charts. Here's the 240. I know this is a messy chart, guys, but bear with me. I'll try and explain it. Focus on this pitchfork right here. 1, 2, 3. The lower the lower 50 line turned right ahead of it. Literally turned right there last night. Both of those lows exposed some divergence in momentum. Price action making a lower low, the oscillator making a higher low. Tells you that there's a chance of exhaustion. That level converges on the basic 618 retracement of the advance right there at 1709. So that's why last night I said, look, even if it were to drop into 1709, I still want to be looking for exhaustion here, and the trade for me is still exhaustion in that. Now, for us to get the conviction for the reversal, we would need just a simple break above 118.06, ideally 118.12, the opening range high for the week, where it becomes a more objective approach, and an objective look at price action would then inherently tell us to look higher. Okay? I kind of was joking yesterday in the update. I said I'm fishing for a bottom here, and we basically are. It's not something that I want to encourage. It's not terminology I like using, but we're basically looking for signs of exhaustion here, and that would match very nicely with the picture of the DXY kind of looking for some resistance. We could be terribly wrong, but if those levels are invalidated, we'll know real quick. At the same point, they turn out. I'm still looking pretty good there on the dollar pullback. Questions on euro. Scenarios for the interest rate decision. Again, if the dollar were to find some balls on the run, then maybe it pulls down into 17. Again, we find some exhaustion there. If the market just shoots, okay, if the dollar just sells off, you have a lot of guys who have pent up long positions. All the expectations for the interest rate hike have been baked in. People who want to be long because of a hike from the Fed are long already. They have been long. So those participants will be more inclined to close out those positions, and it leaves us a little bit more of a risk to try to take that lower. So if it does plow through, don't chase it. You still need to find some sort of corrective pullback to try to get a stop, against this zone looking for a stretch into 1846 and higher. But ideally, looking for some sort of reaction here into the 17 handle to hold as support for euro. If not, look for that run on 1786. Excuse me, 1678. Excuse me. It's the basic 236 of the entire yearly range. First initial target, key support would be down at 1553 in such a scenario. And by the way, 1553, this is, that head and shoulders measured move that we tagged and bounced off of perfectly back here in November. It was the November opening range low. So not the favorite scenario, but got to have the game plan in play. Key resistance as far as the broader topside resistance for euro in general is still 1947, 1977. That hasn't changed at all. Questions, comments, remarks on the euro? Still got the ECB on tap tomorrow again. We'll have a webinar pretty much during the Mario presser, so we'll kind of see what the aftermath is there, but that's still the game plan moving into it. And if tonight you get some sort of basing, tomorrow we'll be very cautious on long side exposure if you're still holding it. Just because, if anything, they'll want to talk down the euro. A stronger euro is not going to help them with the recovery there. Okay. With that on mind, let's move to British pound. Here's what sterling's doing. And I really hope this thing finally gets us some juice because it's kind of been, teeing me off lately. So look, the constructive picture hasn't changed. Here's what the pound looks like on the weekly charts. I gave you all three yesterday. So the weekly charts were showing us still within the confines of this broad ascending channel formation or median line formation. We've been following it for a very long time. Things got hairy here for a while, but it held. Rebound higher certainly doesn't look healthy from a momentum standpoint. Certainly now this long-term momentum trigger now lines up with this basic channel support. And the levels are, the battle lines are drawn, essentially. You need a break above 36.75 to really mark resumption. If we break the lower parallel, maybe a 30-36 pause, but there's nothing to really stop this from dropping back into former trendline resistance. So it's really make or break here, I think, for the pound over the next couple of days. Here's what it looks like on the daily chart. You see a consolidation pattern here into the highs. There's room, okay, for a drop into 32.26. I don't want to see that, but there's room. As a disclaimer, I don't have anything open on pound. I'm looking for something new to get into here, but price action just hasn't been all that encouraging. Take a look at the daily charts. Things looked constructive for me, and I wrote it here in the update back here. Okay, on the 7th, we had an outside daily reversal candle off support, and that support was a basic 38.2 retracement from the advance off the lows we made in August. Well, that was also the swing highs that we made here for the November opening range, and the former swing lows or the former swing highs that we made back in late October. So what a perfect bounce. Great. Let's look for a break above 35.43 to get the continuation. Well, guess what? We turned, and this is what's concerning, exactly at the monthly open. That's what those purple dots are. So we ran into the monthly open. It reversed sharply and closed lower on the session. That's a bearish development all day long. So really bullish candle followed by a real bearish candle kind of throws things off. Add to that, you're just opening up the December opening range. The Brexit talks are doing this. The Brexit talks are doing that. Long story short, I'm looking for basing. Okay, so it's either for me a drop again into 32.72 would be an opportunity. Again, I'd start looking for long exposure. 32.26 still remains our broader bullish invalidation level. If price makes it below there, you really got to start to look at the possibility of a much larger substantiated breakdown in the pound. Again, not my favorite scenario, but those are the risks that we face. Okay, looking for support at one of these two targets. Again, the range is pretty big. 34.95. I would still have a soft target. It's the yearly high day close. Okay, again, that 35.43 level is going to be something we want to respect. The high close for the year, not the high day close, but the high close itself comes in at 35.89. and again 36.75 the Brexit gap. Intraday looks like this. So near-term ascending channel formation, break to the top side, got us all hot and bothered, but there's that 35.43, got a nice pullback, fell right at channel support, perfect reversal, and this was the last update, if you guys remember. I was so excited. Maybe I got too excited on this. Brilliant, I wrote, as this thing came right into a perfect tag of support. Look at that. Perfect 38.2 retrace, perfect trendline support, bam, reversal, and went right into resistance at our initial target there, but it failed right there. And the pullback now, compromising channel support, does leave the risk lower while below the weekly open, so 33.79. We reversed exactly there yesterday. If we break above that, I'd get encouraged. As far as trying to trade that, you kind of don't really have a good risk to reward, guys. So I really wouldn't mess with this unless we get a new low, 100% extension. So just a corrective move would take us down to 32.89. Again, the November opens 32.83. So I'd love to see this hold, and broader bullish inval still basically here at that 32.26 level. So look for a drawback to buy. We'd need to clear 34.32, the objective weekly opening range highs, to really validate the reversal. Questions on pound? Might have gone a little bit too in depth there. I'm sorry, but I've been really trying to gauge how I can get this one in. We'll see. We'll have to see. The BOE is still on tap, so we still have I'm not really expecting much as far as the Bank of England, but it might be the final catalyst. Maybe there's still little guys on the sidelines who are holding on to this one. See how that pans out. But that's the game plan for sterling moving forward. Questions on pound? That's number 3. Okay, we won't get a chance to update this obviously in the webinar. By the time we do our webinar tomorrow, it will be after the interest rate decision. So if you do have any questions on any pound crosses, guys, feel free to throw them on the message board. Aussie dollar, number 4, our favor. Baby girl, Aussie dollar. Loving this thing. Still holding the long that I've been talking to you about since Monday, guys. Well, the long was initiated on Friday, but I've been just holding it. We talked about 75.55 being a level we wanted to see hold the support yesterday. You dribbled a little bit lower, but you did inevitably turn before the close of market in the U.S. trade session. So I held along. 75.88 was level I was looking to take a little bit off, but we kind of just were running as we got through that. So I removed that limit. We'll see how this pans out. I am inclined to hold a little bit through the FOMC interest rate decision. Again, just because of this technical significance, of the level of which we turned from. And that level is 74.76 into the 75 handle. Guys, we've been talking about this one for a very long time. It was, ever since basically August, it was either a drop into 76.30 or a drop into 75 to get long. And that was our basic premise throughout the last, 2 quarters. Here's the drop that you got in October. Again, it sat there. We were looking for long entries. We even had a couple long scalps, but nothing materialized. The final break saw that as, rock solid resistance, and that's still the base case scenario. 76.30. Stretch that into 76.40 to take into account the new 52-week moving average, just a little bit higher, taken out of that zone. That's still the level to break. To really mark a little bit of a key reversal here in Aussie. Remember the region that we're coming out of. The reason I get a little concerned is because, again, I wouldn't put it past this thing, despite the fact that we're up, 90 pips, almost 80 pips on that trade. I wouldn't put it past this thing to jam everyone back into 74.76 before turning. That's the 50% long-term retracement from the ascent off the 2016 lows. Basic trendline support converges right there as well. Not my favorite scenario, okay? Not my favorite scenario. But certainly that's the only thing that would change my mind, is a break below 74.76. That would be super bearish, in my humble opinion. That being said, as all things held constant, I'm looking for the stretch into 76.30. I will do something there for sure. Even ahead of that, the median line comes in at 76.23 or so. If we get up here, I will look to lighten the load. I'm kind of heavy off the lows here, so bring your stop. My stop's at break even already, but if that were to happen, if we were to get that stretch, I'd bring my stop back above to this swing low. Would necessitate a break below this basic near-term trend line, and we'd look for a stretch much higher. 77 would be just a sort of an inside target here. before you get into structural resistance on the upside. So I'm liking it. I'm liking it. It's way too premature to call this the low. Okay, just way too premature. But all things held constant, we're already in a very protective stance on the position. If it comes against us aggressively, no harm, no foul. With the same respect, I think it's worth keeping a little bit on the table here. So ideally, we get into 76 and change, 76, 15, 20 before the release. You take a little off, bring your stops a little bit higher, let it go. But we'll have to reassess as we get there. On a break to the upside, by the way, you have the 200-day moving average at 76.88. That's what I was saying. Just shy of 77 is probably a good place to have your next target if it breaks. But you're looking for structural resistance. So you have the 50 line, the upper 50 line for the current descending pattern that we're in. And then this purple line is this orange line right here, or this red line. And that's the broader support line coming off the yearly lows. So something like this would be the next objective move. All right, near-term support still 75.52. Stretch it to those lows, 75.44. Kind of want to see that hold as support on any pullback here if this immediate advance has legs. Just to drill, where would you place the stop when holding through FOMC? Pooja, on which one? On Aussie? Yeah, so on Aussie, I already have the stop. Well, the stop's at break even right now. I'm not going to lie, but I will be bringing it up to this former swing low from Asia and yesterday in U.S. trade, former swing highs, basically just below this trend line here. So if we break below those former swing lows, break below the trend line, sure, I'll take the hit. It'll be what? It'll be a 40 pip gain at that point. Nice, whatever. But I'm not willing, to take a loss or take too much of the gains off. Does that make sense, Pooja? And let me say one thing also, Pooja. It happens sometimes that maybe market volatility starts to surge. Maybe, I don't know, maybe Yellen gets sick during the meeting or something, and the markets take panic mode or whatever, right? My point being is, even if we were to slam down here and get stopped out, and the market hovers back up and recovers all those losses, I'd still be looking for a new entry against that new low, right? As long as we kind of settle broadly above those former swing lows, that trend line, I'd like to stay constructive. At the end of the day, the only bullish invalidation level is still 75 into 74, 76. This is critical. This is critical. Long term, short term, any way you slice it. Make sense? Pooch says, okay, thanks. Right on. And just for fancy's sake here, I'm sure people find this helpful. Let's just take a real near-term approach here and kind of just see what we're working with. Nothing on slope. Okay, so if you take a pitchfork like that, you see a price action dropped here, price action dropped here, you might be thinking to yourself, oh, that's a nonsense slope. Take a parallel and see if those lines line up. And if you take and extend it off that low, you can see we made a perfect hit. So remember, we're trying to identify the gradient of the market, the slope of which the market is sort of traveling on. And certainly, even though on whole, looking at this slope at first glance looks kind of messy, the lows do follow the same gradient. The median line has offered some nice pivots, resistance, breakthrough, saw acceleration, support, resistance. That might be a nice area to start looking for some near-term support. And this is just a drill, guys, but when I'm in a position, I always kind of want to be mindful of what near-term price action is saying, and wouldn't be too surprised to get some kickback from a little bit higher, 76.10. Might be something to look at heading to the U.S. Open, right? With the same respect, on a real kickback in price, you'd want to see this hold as support. Or more accurately, I should say, let me do this exactly how I would be looking at this, or how I will be looking at it heading into the release. Got to match that slope. This is a pain in the ass sometimes, but just bear with me one sec. Close enough. Take that off the low. And that would sort of be like kind of your bearish invalidation level near term. Your bullish inval, rather. All right. So just a drill there. Hope that helps. Perfect sense. Thanks. You're more than welcome. All right. So let's move right on. That's Aussie dollar, our favorite move so far. Kiwi dollar, number 5, looks very interesting. We were looking for the topside break. We got it. It got hesitant. It's still a little hesitant, but here's the acceleration mode that we've been looking for. So I'll bring this out to the daily chart real quick, and we'll talk about it in just the basic relative case theme. So again, from last night's update, guys, no change to the Aussie levels. Or this was the previous update, excuse me. No change to the previous levels. Again, we just stretched through this, so everything held constant here on Aussie. The previous update highlighted pound odds, which we'll come back to, but I do want to go over the Kiwi. And this is something that we've been talking about for a while. So here's what it looked like on the Sunday open. 68.28. We've been talking about it for months. The 2016 open, we've seen pivots there. It's a basic long-term support level. Take a look back at Kiwi dollar on the weekly charts. Also highlights a major pivot zone there, and as well as the objective yearly opening range lows. We dribbled below there just slightly last month before popping back above, and that's where we found ourselves to start off the month. Now, the reason that we started to get a little bit more constructive was because we tried to probe below. We quickly recovered the final day after. Momentum, right, is essentially finding its way back above 40. And you couldn't really see that concerted hold below 40. You got divergence on that, on that last low, and essentially just looked like it wanted to turn a little bit higher. On the weekly charts, left us vulnerable, right? Short bias vulnerable above 68.30. Key resistance is still at 70 into 70.44. That's a 38.2 retracement of the advance off the lows from 2015, as well as former channel support, 1 touch, 2 touch, 3 touch, break saw acceleration. That's just higher. Also, longer term, this median line formation, the 50 line, the upper 50 line, slices right here, resistance, 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 break saw acceleration, break saw acceleration. That's in this region too. So we were looking for this move higher. I still think it has a little bit more juice in it. Here's what it looks like on the daily charts. There's that same slope, all right? It's a little bit more near-term slope just from the highs that we made last year and this year. Excuse me, the 2016 and this year's high. The median line's right there. The 100% extension of the decline, 70 handle, and the median line converge. So I do think you've got a little bit more upside. There's the divergence I was talking about into that last low. Real strong divergence. Even when we broke this momentum trigger, right? Price didn't show us conviction on that break being operable. But look what happened on the pullback. Look what happened on the pullback. Both of them finding support at that former trigger line. That's sort of confirming the shift in momentum that you're seeing. And here's the upside acceleration. So I do think there's a little bit more upside to go here in Kiwi. Median line comes in just ahead of that 70 handle. 70.07 is going to be the actual 618. At this point, now that we've gotten a reversal pattern underway, basic retracement off the high also will serve us well. So let's see where that comes up. And I've done this before, so basically what I just wanted to highlight is the 38.2 comes in dead on. With the excuse me, what is that? Oh, I have it backwards. I'm sorry. So it's the 38.2. It's the 618. I can do that, undo that again. Sorry about that. Something seemed weird. So this 618 is just backwards. There's your 38.2. Okay, and then and then you have a former swing high pivot right here at 70.90. So 70.77, 70.89. That would be your next upside target. Look at the cluster of moving averages, 200 and 100-day moving averages coming in just higher. So initial target right here, Look for a reaction there. Critical support still 68.30. If you're not long already, kind of like on the Aussie on this one, guys, there's really no point in trying to chase it. You'd be looking for a reaction here and a pullback and a reset to get you that opportunity to get back on the long for a near-term move higher. Keep in mind also, this is a December 12th break of the objective monthly opening range. So here's your monthly open. The monthly opening range took shape just above support. Amen. I don't know if you're in the room. We've been talking about this for a while as far as kind of getting drills for the opening ranges here. So that would suggest you look for a little bit more of a late month high in Kiwi in price action. Any questions on Kiwi moving forward? Here's what the intraday charts look like. Here's what we looked like earlier in the week. So the consolidation pattern did break. It was 69.36 is really what would give us the conviction break to the upside that we were looking for. There was the move. We got a little hesitant there yesterday. There's the accelerated break. 69.66 already taken out. There's 70.07 just higher as our next upside target. Okay, on this trade, I would basically, at this point, I'd want to stay constructive, basically above 69.16, this region right here. Next upside targets here and here. Remember yesterday that we also noted that a conservative measured move of the consolidation break pattern gives you a target at 71.01. Questions on Kiwi? Going once, going twice, and sold. That's number 5 on the session. Number 6 is the abomination. Here's what the dollar-yen looks like. I don't really have much to do here. I kind of, we talked about the short side here, but I didn't have the guts to take it. I still think we could have gotten that spike into 114.30, and it still might, but here's a basic slope. This is just a parallel of the same operative slope we've been working off from the yearly lows. Extended off the October low there. You saw a little hesitation before the break. You just noted that that might be resistance. Also, 114.30 is just the objective range highs for multiple months since May. Dollar-yen is basically largely holding in this range. Near-term support that we've been looking at is a convergence of the 52-week and long-running 200-week moving averages. They're both dead on at 112.17 or so. So that's the level to break, in my humble opinion, to really validate the move lower. Until that happens, kind of just watching what near-term price action is doing. Note that we're turning here right ahead of 60 on the momentum oscillator. Keeps the downside momentum play in focus. Also, here's the near-term chart. Okay, this is the 240. Here's the 120. So an objective look at this price action. It's Wednesday. You're seeing a break of the initial weekly opening range. That would have me looking lower. We're heading to major event risk, though. Dollar-yen extremely sensitive to U.S. event risk. So, look, gunshot approach, I would say this thing does make it down to 1264, and you look for a reaction there. If we break below that level, great. Look for full-on reversal. I'd rather be on the short side of dollar-yen, but all things held constant, that 114.30, 114.50 barrier is still massively critically important and not too far off from where we're trading right now. So on a dollar ripperoo, let's say Yellen comes out a little more hawkish than expected. Even if we rally and rip into this region, I'd still be looking for exhaustion. The emphasis is on a topside break above this to really mark continuation of the up pattern. Till then, you're trading near the range highs. Very simple. Try to break it down as simple as possible. So actually trading it, actually getting into a new position, if you're not already positioned here on the dollar-yen, I'd be looking for a stretch near 112.64 for possible exhaustion. Maybe if you play a rebound long off this region, especially if you're holding, Aussie, excuse me, long positions, or you're holding positions that are short the dollar, on a hedge type of play. If dollar-yen gets into this region for a rebound, might be a decent play for a rebound. Look to the upside. But it's the abomination, so not my favorite play in general. Questions here on dollar-yen? All right, number 7 is the loonie. So Well, we made it through resistance. Okay, we were working with the near-term pattern, if you guys recall, here on Looney. By the way, here's the dollar-yen update from earlier this week. So no change to any of these levels. Okay, we kind of stretched just shy of 1390, and then we turned lower. So the levels remain unchanged. The only thing I've added to this is the retracement into the highs. So again, I'll bring this chart. If you do need to take a freeze frame or a picture of this, feel free to do so. But the only difference, again, is just the addition of that near-term retracement here off the lows. Also, bring up 1248, your near-term bullish invalid. Bring that up to 1264. 38.2, that converges better on that trend line at this point. All right. Dollar CAD. So here, here's the weekly chart. You guys have all seen this before. 29.27, still the major critical resistance level. The downside, you have not only that trendline support, but also the 200 long-running moving average week. So that's sort of the range that we're working with. Near term, here's why we were looking for a turn in the open of the week. The high day close, the monthly open, comes in at 128.86. That's the level we're kind of looking for a hold. If you see a breach higher, again, there's 29.27. Followed closely by the 200-day moving average, basic slope resistance off the early highs. So, looking for signs of exhaustion. There's really nothing there to suggest it was going to be a hold. But near-term price action started to look a little decent. We kind of tacked on this pitchfork, and we saw a hold here into the start of the week and actually move lower. So yesterday, what did it do, guys? It broke right above, it tagged that high day close, and then it moved lower again. So I don't really have a near-term picture that's close on this anymore. Again, just to have continuity here, this is what we were looking at to start the week, right? So it held here, and yesterday in the webinar, I was even telling you guys I was kind of impressed about the fact that we kind of came right into that upper parallel and then broke lower. We were looking for a drop into 128.05. Well, it turned just ahead of that, about a little under 8 pips ahead of that. We broke through the weekly opening range highs. We tagged the high day close, November open. Then we pulled back again right into the lows. So right now all you have is a basic weekly opening range, and that's how I would treat this at this point. I don't want to stress this slope anymore because it hasn't really been, there's really no tags beyond that support structure down there that really got us all excited. To keep us in focus. I'll leave it there for now, but the focus for me is on a simple break of the weekly opening range, notwithstanding the fact that we're still trading into resistance, guys. Resistance is resistance, support is support. We're still there. So I can't get excited about it long because we're right here. At the same point, there's really not that turn in momentum. We haven't gotten any clean signals as far as trying to fade this just yet. A gunshot to my head, I still think you look lower, but to effectively trade that, I still would need a little bit more evidence. So look for today's developments, today's FOMC to offer some volatility. If we do get a spike back into that region, maybe another failure into here would be awesome. But largely speaking, on a daily close basis, I do want to see this respect this slope. It's been so critical, this purple slope, all year long, right? So on a close basis, it's still been rock solid. And that's what it needs to remain if we're going to stick with this broader downside assumption here in Looney. Questions on dollar CAD? All right. A quick update on pound Aussie. This is also one that we highlighted earlier in the week. Here's what we were looking at. We've been tracking this one since the start of the month, and the basic play here, we were tracking on the way up into the 180 handle, and then once it turned, we talked about this in the webinar yesterday, things start to look very hairy. You have some pretty strong divergence on the daily charts into this high, and we've been favoring the Aussie long. The Aussie long would certainly be a downside pressure on pound Aus, and with pound breaking down, sort of seemed like a basic play to look lower. So the focus was on a drop into 170. That was sort of the near-term support structure that we would need to see break to really validate the move lower. We got that move, and here's what it looks like now. It's been a slow kind of dribble lower, but not with much conviction at this point. Yeah, well, obviously the Aussie rally that we're seeing near term is pushing this even lower now. So here's what I was looking at last night. I want to see these breaks accelerate. So when you see this kind of thing happen and we were getting some divergence, I couldn't get myself to pull the trigger on a short. Obviously, you got another opportunity here on the reversal, but I didn't see it. So here's the break lower. Look for a near-term hesitation here, but the basic focus is for a move back into November open. That takes you into 73.46, 73.50. It's the lower parallel. And again, that November open, former swing lows right down there. Near-term resistance at this point, and what I would deem as sort of bearish invalidation, sort of be right up here. Okay, 77.93, basically just below the 78 handle. Other than that, if you were to get a rebound here off this region, look for resistance triggers against that high. If we do clear that pivot, again, this dotted line here, I would be expecting that run into the median line. And again, we'd start to look to reassess there. I don't want to get too excited here, guys, on really getting aggressive, because if the pound finally found some support like we're looking for, it may not cause this to rally per se, but it could really curb the downside momentum. So something to keep an eye on here for pound Oz. Okay, so one pair there out of everything that we covered today. If you do want to stay away from the dollar, you do have options elsewhere. Last but not least, here's what gold looks like. I've been talking to you guys about this region forever. 1240 is still huge. We dribbled below an overnight trade. Here's the rebound and reversal. 1240 is maximum. That's where I want to see the lows hold. I'll bring your attention again to the daily charts, all of which really highlight this region with a little bit more clarity. You got a basic 50% retracement of the advance off the December lows of last year, so basically all of 2017 trade. Some basic slope, not really crazy, but some basic slope, and a 618 extension of the decline gives you 1246. So 1239, 1240, 1246 has been the region that we've been watching. If we settle below here, there's nothing really to stop this thing from going to 1210. Okay, dollar's at resistance, euro's at approaching near-term support. If we find that kickback and that support in the euro, reversal in the dollar, certainly would be a little bit more of a supportive play for a rebound here in gold. But the emphasis is really on a weekly close above 1240. Here's the weekly chart even looks like for gold, reflecting the same exact thing. Weekly chart has a little bit more of a room for a drop here at 1232 without getting all hot. Basically, that's the long-running 200-week moving average, so I'll give it a little bit more respect. But again, there's really nothing to stop from 1210 on a breakdown beyond here. All right. So gold flirting with disaster, not there yet. Looking right over the edge there, 1240 near-term support. We need to see hold into today's release. Any other questions from you guys? I can't believe I'm actually early here on Fed Day, nonetheless. I might have gone on a little rant there on the side notes, but let me know if you have any other questions or trade setups you want to review. Broadly speaking, again, the emphasis is on a possible dollar exhaustion play. It would be our ideal scenario. In the event of dollar weakness, Aussie is going to be our favored move. Depending on where pound is going to be our favored move, and actually yen would be the favored move on a move lower, right? In the event of dollar strength, you really got to focus on the euro, and if it settles below that near-term confluence region, like I said, if it settles intraday charts, if it settles below this region right here, on the intraday on 1709, I do think you get the larger breakdown in euro if that happens, but the emphasis is really on that 1709 level. So the slam to the downside here, that would be the dollar strength move I'd be looking for in such a scenario. Okay, devil's in the details. I'll hit you with the releases as fast as I can, as soon as it comes out on the SB Squawk feed and my Twitter handle. So keep your eyes and ears peeled there. But it's going to be the presser with Janet Yellen. So 2:30 as we get those remarks crossing the wires. We'll continue to keep you updated. Again, there's really not much she can say that'll really change the course of monetary policy moving forward. It's all about the projections. If the Fed sees that inflation is going to remain stubbornly low, if there's concerns about that, if there's dissenters, okay, to today's hike, essentially committee members who voted against it, that would show again that there's probably a little bit more concern about the inflationary picture being slower than expected, and maybe the markets are right to be pricing in. Again, right now we're pricing in 1, maybe 2 hikes next year. The December expectations are starting to crawl a little bit higher for Fed fund futures. The Fed is still calling for 3. The question is, does their 3 actually move till 4? And if they start to expect 4 hikes next year, the market's at 1 or 2. Again, that could give a little bit legs to the dollar, but all things held constant. You guys know the game plan. You guys know the key levels, and I wish you all the best of luck. I will see you all tomorrow morning, and we'll keep you updated on SB Squawk, guys. Have a good day trading. Cheers.